Shoes.
Hi, I'm Mike Tomczak.
Alex Stavanovich.
And Katie O'Neill.
And we are Smack Footwear. Today we'll be going over the last 10 years of our business operations.
Today we will be covering the following: a mission and vision statement and our competitive strategy, including wholesale, internet, and private label.
The production strategy and the financial strategies.
We'll also be looking at relevant competitors, financial performance versus our financial goals, and lessons learned throughout the past 10 years.
And first, our vision statement for Team Smack is we plan to become the leading global provider for affordable shoes for footwear enthusiasts of all kinds. And our mission statement for Team Smack is that Smack Athletic Shoes strive to provide quality products to our customers while maintaining focus on our many cultural, environmental, and economic initiatives. We offer a wide variety of products across the globe, all while minimizing our carbon footprint through the use of green materials in our products and recycled packaging material. Our employees enjoy a comfortable work culture, competitive wages with productivity incentives, and also attend regular training to help maintain our high-quality standards.
Smack's competitive strategy in regards to wholesale and internet was wide variety of models offered, fair price when compared to competitors, moderate advertising spending, mail-in rebates offered to all markets, a 3-week delivery to all markets, and a competitive S&Q rating. And the competitive strategy in regards to our private label is plan to be leader in this market segment, focus on lower cost markets, utilize any and all unused wholesale and internet capacity, take advantage of potential gains with respect to exchange rates, and sustain higher growth rates in both wholesale and the internet.
Smack Footwear's production strategy is as follows. We plan to sustain inherited plants in North America and Asia Pacific regions, construct a new plant in Latin America, and continue to expand as needed to continually capture the majority of the available private label market. If demand supports it, overtime will be utilized for private label shoe production, and yearly base wage increases, incentive pay, and best practices training for employees will improve product quality. Our finance strategy is as follows. Dividend payments were lowered in year 11 and subsequently suspended to ensure available cash for growth. We have a low amount of loans and debt compared to our competitors. We issued 600,000 shares at $18.22 a share in year 13 to fund our continued expansion in Latin America. And our credit rating has only twice dropped below investor expectation under this current ownership.
What you're looking at here are our revenues from years 10 to 15. What we experienced during this period of time was a 64% increase across the time, construction of a new plant in Latin America in year 11, and we're beginning to attack the private label market. Some notes regarding our earnings per share for years 10 through 15. We were at or above expectations for years 10 and 11. We experienced poor market conditions in years 12 and 13, which caused some issues. Favorable exchange rates in year 14 caused a 434% increase in earnings per share. Year 15 decreases, but remains above investor expectation. And across this time period, we met investor expectation 66% of the time. Our return on equity for the first 5 years experienced similar trends with regards to market reaction as the earnings per share did. Damages to net revenues in years 12 and 13 from the poor market conditions also damaged our return on equity. However, we met investor expectations 50% of the time during this time period. Since stock price is a function of the 3 previous measures, stock price followed similar patterns with regards to the market decline and the market uprise. However, over this period of time, we were still able to meet investor expectations 2/3 or 66% of the time. And now we'll take a look at our credit rating for years 10 through 15. Lower than industry average borrowing has assisted in maintaining the expected credit rating. Years 12 and 13, when the market was experiencing some turmoil, we did have to borrow a little bit more than we would like to, so this contributed to our lowered credit rating. Since then, we've maintained a healthy debt to assets and interest coverage ratio and a low default risk, which has helped us meet this investor expectation 66% of the time throughout this time period. Finally, we'll take a look at our image rating for years 10 through 15. During this time period, we met or exceeded investor expectation 83% of the time. In fact, every single year except year 11. During this time period, we maintained comparable S&Q ratings and market share with our competitors, and our continued efforts in both green material use and social responsibility helped keep this image rating where our investors expected it to be. What we have here are two graphs, one depicting the wholesale segment and the other the internet segment, of our competitive position. What this graph is going to show us is where we lie with regards to our closest competitors. As you can see along the bottom axis, this measures how many models you have, more towards the right. We're represented by the medium-sized green circle underneath the blue circle in the wholesale segment. So as you can see, we offer a wide variety of models, and we're on the higher end of that scale. The left axis represents price and S&Q rating. As you can see, we're right in the middle with that, which means we have a competitive price with regards to our competitors. What we may do in the years coming is reduce the amount of models that we offer so that we can maybe distinguish ourselves from our competition just a little bit more and gain a competitive edge in that way.
After 5 years of managing the company, some strong competitors have emerged. These companies include Hot Sneaks, Ideal Shoe, and D's Kicks, and they have continually been our closest competitors during these first 5 years. What we've done is we've shifted our focus to markets more conducive to our competitive strengths and away from their markets of strength. We also sold off our North American production facility in year 17 due to continued rising costs and currency depreciation.
With 5 years of experience with the company behind us, we could now make some changes, and hopefully things would improve in the following 5 years. What we're looking at here is the graph of our revenues for our entire management tenure, but the focus would be on years 16 through 20. Year 19 saw the second highest revenue of management tenure. We had $405 million. We ended year 20 7% higher than year 16, and the final 3 years saw private label sales climb to 40% of total revenues, which is exactly the direction we were trying to move in. Now we'll take a look at earnings per share years 16 through 20. During this time period, we met investor expectations 60% of the time. After our sale of the North American production facility, our earnings per share skyrocketed, as you can see on the tail end of the graph, which prompted us to reinstate the dividend in year 20. Now we'll take a look at our return on equity in years 16 through 20. We had some difficulties in years 16 and 17, but felt that we more than made up for it in years 18 through 20, as you can see again on the tail end of the graph. During this time period, we exceeded our investors' expectations 60% of the time. And as expansion continued in markets of our strength, mostly the private label, our net revenues grew, which caused the spike in return on equity. Next, we'll take a look at our stock price from years 16 through 20. Our slowed earnings in years 16 and 17 contributed to a lowered stock price. However, the reinstatement of our dividend at $6 per share in year 20 resulted in the highest stock price in the past decade at $257 per share. In fact, with this spike, our stock price grew 778% from year 16 to year 20. Here's our credit rating for years 16 through 20. As you can see, we exceeded the investor expectation for the entire 5-year period. Conservative borrowing has given us extremely low levels of debt. In fact, we had 0 debt owed in years 19 and 20, which gave us industry lows in both debt to assets ratio and default risk. Finally, we'll take a look at our image rating for years 16 through 20. Our image rating fell within 5 to 10% of investor expectations for the entire 5-year period. We were able to maintain this level through continued training, quality upgrades, and employee piecework incentives. We also maintained competitive S&Q rating and also had a comparable percent of superior materials used with our competitors. Finally, we're going to take a look at some of our production strategies going forward for years 21 and 22. Finally, we'll take a look at our competitive position as it stands at the end of our 10-year business operations. Again, here are pictures of our wholesale and internet segments, and we are represented by the green, smaller size circle towards the bottom left. As we said previously, we did reduce the amount of models that we offered slightly, and also lowered our pricing with hopes of distinguishing ourselves from our competitors and moving away from the cluster. Unfortunately, our competitors seem to have followed suit, but this still didn't stop us from turning high profits, raising our stock prices and our return on equity, and continue to meet our investors' expectations. What we'll do going forward here is we'll tell you a little bit about what we're planning on doing in the next coming years.
Going forward, the competitive strategy that we'll be using for the next couple of years will be early construction plant upgrades and continued capacity additions in Latin America have allowed for high profit margins. We will continue to exploit this advantage in the future. Low debt levels will allow for affordable borrowing should demand require capacity additions or upgrades. Continued expansion in Latin America to capture more of the Latin American and North American private label markets.
Finally, we've set these financial goals for years 21 and 22. We were aiming for an earnings per share of $10 or more, net revenues exceeding $450 million, a return on equity of 18% or more. We'd like to keep our credit rating at least an A, hopefully an A+. Our image rating, we would like to be at 70 or better, and we would also like our private label and wholesale sales to end up being at least a 50-50 split, with hopes to continue increasing our private label sales.
Let's get some shoes. Let's get some shoes. Let's get some shoes. Let's get some shoes. 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 Oh my god, shoes. Shoes. These shoes rule.